What do I start when it drops almost? This is the Vivendi Universal case. Put your phones down and prepare to be amazed.
Vivendi Universal, a French media company, was suffering a liquidity crisis during the 2000s. Instead of reporting it as it was, they instead engaged in earnings management, as well as cycling their debt through subsidiary companies without proper reporting. When they were discovered, both the company and the former CEO and CFO were charged with a civil lawsuit for fraudulent activities. The CEO and CFO both claimed that their actions weren't illegal or unethical, despite evidence to the contrary, and Vivendi Universal was forced to pay retributions of $48 million to 12,000 investor victims.
Question 1. Analyze the actions taken by Messier in the case from the perspective of discussion leadership in Chapter 8. Ethical leadership refers to leadership actions which gives value to others' beliefs and respect others' people's beliefs and values. Its concepts are about fairness, trust, honesty, and consideration. Leaders with ethical leadership respect others' people's beliefs and lead the path through righteousness. Vivendi acquired Universal Music Group, Seagram, and Universal Studios. All this acquisition costed Vivendi its cash reserves, it sold away stocks, and had a debt of over $60 million. When the new management took over, they had no idea about the stability of Vivendi because the previous management was issuing press releases every now and then to boost the company's image in the public. Vivendi management resorted to EBITDA principle. The company hid their liabilities in their report. It never discloses parts of the acquisition cost incurred to acquire new companies. The company and the old management were charged by SEC. The actions taken by Messier are in total contrast with the theories of ethical leadership. The following activities that Messier engaged are: first, Vivendi resorted in issuing false press releases about the company's financial status. Second, Vivendi resorted to EBITDA management, which was unethical and unfair. Vivendi never released the company's liabilities in the yearly performance report. And the last one, Vivendi did not disclose all the details of acquisition cost in their financial report. In conclusion, Messier departed from the path of righteousness and ethical leadership.
Question number 2. Explain how internal controls can facilitate ethical behavior and help prevent financial impropriety. What was the role of internal controls in the Vivendi fraud? Internal controls has a huge role in the facilitation of ethical behavior. Internal controls are processes for assuring achievement of an organization's objectives in operational effectiveness and efficiency, reliable financial reporting, and compliance with laws, regulations, and policies. As we have learned from the fraud triangle, the more opportunities there are to commit fraud, the more likely there is fraud to be committed. In the case of Vivendi, there was a lack of internal controls and a lack of separation of duties. This creates many opportunities for fraud to be committed. The ultimate downfall of Vivendi was the failures in ethical practice, corporate governance, and leadership as the root cause. In the case of Vivendi, there were many instances that showed how weak the internal controls really were. They had a lack of internal control mechanisms to prevent and detect fraud, and also had an ineffective control environment to prevent and detect fraud. Vivendi also made use of the loopholes in financial reporting standards to alter numbers as far as possible to achieve a desired goal. The process of earnings management, false earnings announcements, and excessive risk-taking entailed what the corporate culture was like at Vivendi. Senior executives used 4 different methods to conceal Vivendi Universal's financial problems. Number 1 was issuing false press releases stating that the liquidity of the company was strong and excellent after the release of the 2001 financial statements to the public. Number 2 was using aggressive accounting principles and adjustments to increase EBITDA and meet ambitious earnings targets. Number 3 was failing to disclose the existence of various commitments and contingencies. And lastly, number 4 is failing to disclose part of its investment in a transaction to acquire shares of Telco, a Polish telecommunications holding company. Vivendi Universal failed to mirror the COSO framework, which details 5 components that are all necessary for strong internal controls. These 5 components include control environment, risk assessment, control activities, information, and communication and monitoring. You could make a case that Vivendi failed to mirror the COSO framework and therefore suffered from weak internal controls. The company consisted largely of egoistic behavior, and it was clear that Vivendi Universal was out for themselves. They wanted to increase their numbers to meet Wall Street expectations and took advantage of many opportunities to commit fraud and unethical behavior. The ethical tone at the top plays a very large role in the behavior of the company and willingness to commit fraud. Strong internal controls and separation of duties would have likely found these problems and stopped them. Vivendi enabled the fraud to occur and prevented the coming with the crisis as it unfolded.
Question 3A. Why do financial analysts look at measures such as EBITDA and operating free cash flow to evaluate financial results? Financial analysts look at EBITDA to evaluate financial results because earnings can be more comparable from company to company. Tax rates are different between companies, depreciation and amortization methods also vary between companies. Because of this, analysts believe that the EBITDA is a truer representation of how a company is performing. Financial analysts want to look at operating free cash flow to assess the strength of a company and its ability to please investors by generating profits. The operating free cash flow shows if a company is able to make profit enough to cover its operating costs and after deducting capital expenditures. Question 3B. How do these measures differ from accrual earnings? These measures are different from accrual earnings because they are determined on a cash basis. Analysts who use these measures want to see the actual cash flow of the company without any accruals. Cash-based accounting does not comply with GAAP or IFRS, while accrual accounting does. Question 3C. Do you believe auditors should be held responsible for auditing such information? The numbers used to create the EBITDA and the operating free cash flows are audited numbers. However, the EBITDA and the operating free cash flows are not. Because EBITDA and free cash flows are cash-based methods, they are not acceptable under GAAP or IFRS. An auditor wants to make sure financial statements are in accordance with GAAP. An auditor cannot put the GAAP stamp of approval on these non-GAAP methods. Firms could have their internal auditors be responsible for auditing this information. The audit would be less about complying with GAAP or IFRS and more about truthfulness. This will help keep the firms honest and will better serve the public. Even when firms are honest, the EBITDA can still be misleading. When analysts consider non-GAAP measures, they should be aware of what they are not able to see. The analyst should use multiple methods of analyzing a firm, including audited reports.
We'll now be moving on to our own questions. For the first one, we have compare and contrast the situation of Vivendi with Enron and WorldCom. How are they similar? How are they different? Did they both have the same outcome? Like Enron and WorldCom, Vivendi Universal had several failures that allowed unethical behavior. First, the CEO and CFO didn't set an ethical tone at the top. Instead, they were too focused on money, meeting the financial expectations to care for such. In addition, they engaged in alternative accounting practices. Whereas Enron employed a more future-oriented accounting, Vivendi employed earnings management, which made them appear better than they actually were. In addition, they also held press conferences saying that they were doing great when in fact they were in trouble. In the case of Vivendi, they had a liquidity crisis. Another thing that links them with WorldCom and Enron and Vivendi were operating on debt and purchasing other companies that were expected to be able to help them spread their debt. Another similarity is that they all employed subsidiary companies to buy their debt that the head company would later buy back to repay. Another striking similarity is that the CEOs and CFOs all denied their actions were unethical. While Vivendi was able to pull through for the most part, they did have to make reparations to a large number of stakeholders. In the end, however, the CEO and CFO of Vivendi Universal didn't suffer as much as the CEO and CFOs of Enron and WorldCom because they were found not to have scienter. Regardless, all the companies were made to pay for their wrongdoings.
Question 2. What GAAP or AICPA principle did the executives of Vivendi violate? Under the GAAP principle, executives of Vivendi Universal violated the going concern principle that states a company will continue to exist long enough to carry out its objectives and commitments and will not be forced to halt operations and liquidate its assets in the near term. With the executive using different methods to conceal financial problems, they are leaving their stakeholders in the dark, leading them to believe what's in front of the curtain is correct and strong while everything behind the curtain is breaking down and falling apart. They also violated due care and professional skepticism. Due care refers to the effort made by ordinary, prudent, or reasonable party to avoid harm to another, taking the circumstances into account. There was a long list of shareholders and shareholders that will be harmed from Vivendi's neglect, unethical behavior, and Vivendi's failure to realize the consequences of their crime before it was too late. Under the AICPA Code of Professional Conduct, the executives are violating most, if not all, of the principles. For example, Section ET 53, Article 2 states members should accept the obligations to act in a way that will serve the public's interests, honor the public's trust, and demonstrate commitment to professionalism. By falsifying the financial statements and continuing to run the company as if nothing is wrong, it gives the public a false sense of comfort that will eventually break when everything comes to light. Question 3. From which ethical perspective could Mesmer defend himself with and how? Mesmer could defend himself and his actions using act utilitarianism, ethical perspective. Act utilitarianism belief are that an act becomes morally right when it produces the greatest good for the greatest members of people. This perspective validates Mesmer's ethical behavior as it allows the company to stay afloat. Therefore, the employees of the company will still keep their jobs, thus allowing the greatest good for the greatest number of people.
Wait, what am I supposed to say? Case in class? Yo, what's up? What's up? This is 456 class. Vivendi Universal case. Yo.
I don't think you can say that.